On January 29th, 2026, something changed in global trade without a single ship being stopped. Several major maritime insurers quietly adjusted war risk premiums for vessels transiting the Strait of Hormuz. The increase was small in percentage terms, measured in fractions of a percent of hull value, but large enough to be written into new contracts almost immediately. No tanker was attacked, no shipping lane was closed. Oil continued to flow. From the outside, nothing appeared to happen. Fuel prices did not spike overnight. Store shelves stayed full. Markets barely reacted. For most people, this adjustment passed completely unnoticed. But inside shipping contracts, energy pricing models, and logistics agreements, the cost of moving the world's most critical commodities shifted slightly, quietly, and in a way that tends to linger. Insurers updated risk tables. Shipping firms recalculated surcharges. Energy traders adjusted volatility assumptions. All of this occurred without a press conference, without emergency legislation, and without a declaration of conflict. Just paperwork, and almost no one paid attention. At first glance, this looks like a familiar story. Iran, regional tension, rhetoric without action. Most coverage frames it as another round of geopolitical signaling. Important, perhaps, but not urgent. After all, ships are still moving and oil is still available. But this story is not primarily about military escalation, and it's not really about nuclear negotiations either. What's unfolding here is something quieter. This is about how risk enters the global economy before conflict ever does. Insurance markets do not wait for wars to start. They respond to probability. When insurers adjust premiums, they are not predicting disaster. They are pricing uncertainty. Once uncertainty is priced, it spreads. That cost does not stay with insurers. It moves through shipping contracts, energy prices, airline fuel costs, manufacturing inputs, and eventually household budgets, not all at once, gradually. This is why the most important signal wasn't a missile test or a diplomatic breakdown. It was a technical change buried inside maritime insurance clauses. The danger is not escalation in the traditional sense. The danger is normalization. When higher risk becomes routine, reversing it becomes harder than escalating ever was. And by the time the impact feels obvious, the adjustment has already been absorbed. To understand what is happening, we need to give it a name. This phenomenon can be described as the maritime risk transmission cycle. The term matters because this is not a single event, and it is not limited to Iran. It is a system, one that converts geopolitical tension into economic pressure without requiring open conflict. Here's how the cycle works. First, tension rises around a strategic choke point but remains below the threshold of war. The ambiguity is intentional or structural. No red lines are clearly crossed. Second, insurers respond, not politically but mechanically. They adjust premiums, coverage limits, and exclusions to protect capital against uncertainty. Third, companies adapt. Shipping firms pass costs forward. Energy traders price wider ranges. Manufacturers build buffers. Airlines hedge fuel exposure. Each decision is rational on its own. Fourth, those small adjustments accumulate. Transport becomes slightly more expensive. Energy becomes slightly more volatile. Planning horizons shorten. No single change feels decisive, but together they reshape behavior. A useful metaphor here is a toll road you didn't realize you were on. The road remains open, traffic keeps moving, but each mile costs a little more than before. You don't turn around because there's no alternative, and because the increase feels manageable, until it isn't. The maritime risk transmission cycle does not depend on war. It thrives on hesitation, complexity, and plausible deniability. It operates through contracts rather than confrontations, premiums rather than policies. Once it starts, it becomes self-reinforcing. Higher risk raises costs. Higher costs limit political options. Limited options sustain ambiguity, and ambiguity keeps risk elevated. This is why the system is so easy to miss and so difficult to stop. The most important effects don't appear at the point of conflict. They appear downstream in prices, investment decisions, and long-term confidence. And by the time those effects feel unavoidable, the cycle is already in motion. What makes this system difficult to recognize is that, on the surface, almost nothing changes. There is no treaty announced, no blockade declared, no emergency session convened. Instead, pressure builds inside structures that rarely attract attention. Insurance schedules, shipping contracts, risk models, and quiet policy constraints that operate far from public debate. The first layer of this structure is maritime insurance, which acts less like a safety net and more like an early warning mechanism. Insurance firms do not react to speeches or intentions, they react to probability. When regional tension increases, even without violence, insurers reassess how likely it is that something could go wrong and how expensive that outcome might be. If uncertainty rises, premiums rise with it. Not dramatically, incrementally. A fraction of a percent added here, a new exclusion clause added there, shorter coverage windows, higher deductibles. None of this makes headlines, but every shipping contract written afterward quietly incorporates those changes. Shipping companies rarely absorb these costs for long. They pass them forward through surcharges that are labeled temporary, even when they persist. Energy firms then incorporate those costs into pricing assumptions. Airlines adjust fuel hedges. Manufacturers recalculate logistics expenses. Each step is small. Each step is rational. Together, they raise the baseline cost of moving goods. Energy markets feel this structure early, not because supply disappears, but because uncertainty becomes harder to price. When transport risk increases, future deliveries become less predictable. Traders hedge more aggressively. Volatility widens. That volatility itself becomes a cost embedded into long-term contracts. This is how inflation can rise without a shock. Prices do not jump because something breaks. They drift upward because risk is being continuously priced in. The next layer of the structure is global supply chains, which are designed for efficiency, not ambiguity. Modern supply chains work best when routes are predictable and costs are stable. When uncertainty persists, firms quietly adjust. They hold more inventory, they shorten contract durations, they diversify suppliers even when it is more expensive, they delay large capital investments. Individually, these decisions look prudent. Collectively, they slow the global economy. What makes this structure durable is that adaptation replaces urgency. Firms stop waiting for stability to return and begin operating as if higher risk is permanent. Once that happens, political resolution becomes less pressing because the private sector has already absorbed the adjustment. The structure then intersects with political constraints, especially inside the United States. Clear escalation carries visible risks. Clear de-escalation carries political costs. So policymakers often tolerate ambiguity. This keeps options open, but it also keeps insurers cautious and markets defensive. Alliance dynamics add another layer of friction. Allies share strategic interests, but differ in their tolerance for higher fuel prices, inflation, and economic disruption. Coordination takes time. During that time, markets continue to adjust. Election cycles further narrow choices. Leaders facing voters are reluctant to take actions that could raise gas prices or disrupt trade, even temporarily. That limits the range of credible signals that can be sent to markets. As a result, capital moves faster than policy. Investors do not wait for clarity. They price uncertainty immediately. Capital shifts toward assets perceived as resilient to instability, energy, commodities, logistics, defense, while long-term investment in trade-dependent sectors slows. Growth does not collapse, but it becomes more fragile. This is not a market failure. It is a rational response to uncertainty. Another critical layer is proxy signaling. In environments where responsibility is unclear, indirect actions can raise perceived risk without triggering retaliation. The structure rewards deniability. Insurers do not need attribution to act. They only need probability. As long as uncertainty remains elevated, premiums remain high. This creates a subtle feedback loop. Ambiguous actions raise insurance costs. Higher costs increase political caution. Political caution sustains ambiguity, and ambiguity keeps risk priced in. The final layer is institutional friction. Policy responses must move through agencies, legislatures, courts, and public opinion. This does not mean paralysis, but it does mean delay. Markets, insurers, and firms adjust faster than governments can coordinate. By the time a response is debated, implemented, and communicated, the system has already adapted. That adaptation becomes embedded in contracts, pricing models, and investment plans. What looks like inaction from the outside is often the result of overlapping constraints on the inside. Taken together, these invisible structures form a self-reinforcing system. Risk raises costs. Higher costs limit political options. Limited options sustain uncertainty. Uncertainty keeps risk elevated. No single actor designed this system. It emerged from incentives interacting over time. And once it exists, it does not require constant escalation to persist. It only requires uncertainty to remain unresolved. That is why this issue is quiet, why it spreads without headlines, and why its effects are often felt long before they are understood. Escalation in this system does not begin with confrontation. It begins with acceptance. In the early phase, very little appears to change. Ships continue to transit the Strait of Hormuz. Energy supplies remain available. Markets open and close as usual. From the outside, the situation looks stable enough to ignore. But inside the system, assumptions begin to shift. Insurers treat elevated risk as temporary, but they do not remove it. Shipping companies add modest surcharges and describe them as short-term adjustments. Energy traders widen hedging ranges. None of these decisions signal panic. Each actor is simply protecting itself against uncertainty that may or may not materialize. At this stage, ambiguity actually contains escalation. Governments avoid decisive moves to prevent a crisis. Markets interpret restraint as reassurance. Proxy signaling remains limited, precisely because it works. The cost of uncertainty is real, but still manageable. No one feels pressure to force resolution. Over time, however, the system stops expecting normalization. Premiums do not fall back to earlier levels. Contract language remains cautious. Temporary measures become standard practice. Firms stop asking when risk will fade and begin planning as if it will persist. This is the point where escalation becomes structural rather than event-driven. Shipping routes are adjusted slightly, not to avoid choke points entirely, but to reduce exposure. Delivery times lengthen. Inventory buffers grow. Energy importers lock in higher long-term prices to avoid volatility. These adaptations do not disrupt trade, but they reduce efficiency. The economic impact becomes visible, though still difficult to attribute. Inflation feels sticky. Central banks hesitate to ease policy. Growth slows at the margin. Political leaders face rising frustration from voters who sense higher costs without a clear cause. At the same time, proxy activity becomes more frequent but remains calibrated. Actions stay below thresholds that would force retaliation. Each incident reinforces the perception that uncertainty is durable. Insurers respond accordingly. Markets adapt further. As months pass, costs begin to shape political behavior more directly. Governments are no longer debating escalation in strategic terms alone. They are responding to domestic consequences. Energy subsidies strain budgets. Trade-dependent industries lobby more aggressively. Public tolerance for prolonged uncertainty erodes, even if appetite for open conflict remains low. Alliance dynamics complicate matters. Partners share broad goals but differ in their tolerance for economic pain. Some prioritize deterrence, others stability. Coordination weakens not because of disagreement over objectives, but because of disagreement over timing and cost. Markets register this divergence. Volatility increases. Capital shifts toward assets perceived as resilient to fragmentation. Long-term investment in trade-intensive sectors slows. Younger workers entering these industries face fewer stable opportunities, even though demand has not collapsed. At this point, escalation no longer depends on new shocks. The system itself sustains pressure. Firms begin making longer-term structural adjustments. Supply chains are redesigned with redundancy rather than efficiency in mind. Energy strategies prioritize security over price. These decisions are rational responses to uncertainty, but collectively they raise costs and reduce growth potential. Institutions struggle to keep pace. Rules built for a stable, integrated world are applied to one that is fragmented and cautious. Compliance costs rise, disputes multiply, decision-making slows further, reinforcing uncertainty rather than resolving it. Proxy signaling continues, but its role changes. It no longer needs to escalate. The baseline level of risk is already high enough to maintain pressure. The system has internalized instability. Eventually, accumulated strain forces some form of resolution. This does not necessarily arrive as war or peace. It arrives as change. In some scenarios, resolution comes through shock. A single incident breaks ambiguity and forces decisive action. Markets react sharply, but clarity returns quickly. Costs spike, then settle into a new equilibrium. In other scenarios, resolution comes through reset. A negotiated framework emerges that does not eliminate risk, but restores predictability. Higher baseline costs are accepted in exchange for clearer rules. The system stabilizes at a less efficient but more legible level. In neither case does the system return to its previous state. By the time resolution arrives, expectations have already adjusted. Contracts reflect higher risk. Investment patterns have shifted. Trust has been recalibrated. The structure of global trade has changed. What makes this escalation ladder dangerous is not aggression, but inertia. No actor needs to choose escalation. They only need to delay resolution. In systems governed by insurance contracts and risk pricing, delay is often the rational choice. Each step feels cautious. Each adjustment appears defensive. Yet together they move the system upward. There is no single moment to reverse this process. No dramatic decision that resets conditions overnight. Pressure builds quietly, spreads widely, and hardens slowly. And by the time it becomes obvious, the ladder has already been climbed. Situations like this often feel new because they do not resemble the crises people expect. But history offers mirrors, never exact matches, yet patterns that repeat in quieter forms. In the mid-1980s, during the Iran-Iraq conflict, commercial shipping in the Persian Gulf did not stop. Tankers continued to move even as attacks occurred. The objective was not total disruption, but economic pressure. Insurance premiums rose sharply, escorts became necessary, and energy markets priced fear well before supply collapsed. What mattered was not how many ships were hit, but how many might be. Earlier still, disruptions of the Suez Canal showed how a single choke point could reshape global trade without destroying it. Ships rerouted, costs accumulated, political influence shifted toward those who could guarantee reliability rather than control territory. The economic impact spread far beyond the region and lingered long after headlines moved on. These episodes help explain the present, but they are not perfect analogies. What is different today is speed and structure. Modern supply chains are faster, leaner, and more tightly coupled. Capital moves instantly. Risk is priced continuously rather than episodically. In earlier eras, disruption arrived visibly through blockades, sinkings, or closures. Today, disruption often arrives statistically. Instead of ships being stopped, premiums rise. Instead of routes closing, contracts change. Instead of panic, adaptation. That adaptation is what makes the present moment distinct. Rather than forcing resolution, the system absorbs pressure gradually, and gradual pressure is harder to mobilize against. Historical analogies are useful because they remind us that commerce has long been a battlefield. They are imperfect because the mechanisms have shifted. The struggle is no longer primarily over access, but over confidence. Not over territory, but over predictability. History does not tell us what will happen next, but it does suggest something uncomfortable. Prolonged instability often emerges not from decisive confrontation, but from long periods where everyone adjusts just enough to keep going. For most people, this kind of escalation never feels geopolitical. It feels practical. Middle-class households tend to notice it as background pressure. Fuel costs rise unevenly. Grocery bills creep upward. Flights and shipping fees become more expensive. Nothing spikes dramatically, but monthly budgets feel tighter. Wages may rise, yet not quite fast enough to keep pace. Planning becomes harder, not because of fear, but because of uncertainty. For retirees, the effect is quieter but more direct. Fixed incomes are sensitive to essentials. Energy, food, and healthcare matter more than market narratives. Even modest, sustained price increases can affect confidence about long-term security. Investment accounts may grow in nominal terms, yet purchasing power feels uncertain. As a result, large decisions, travel, downsizing, helping family financially, are often postponed. Small businesses experience the pressure operationally. Shipping costs fluctuate. Input prices become less predictable. Margins thin. Owners hesitate to hire or expand even when demand exists. Many small firms rely on stability more than scale, and prolonged uncertainty erodes both cash flow and confidence. Resilience increasingly means standing still. Future workers, those under 30, feel the impact indirectly, but it shapes their choices early. Entry-level wages struggle to keep up with higher baseline costs. Career paths become less linear. Short-term contracts replace long-term ladders, especially in trade and travel-exposed sectors. Saving for retirement is delayed, even as volatility increases the importance of early investing. Across all groups, the common experience is compression. Less room to absorb shocks, less margin for error. Fewer clear signals about where opportunity lies. This is how geopolitical risk becomes social risk, not through dramatic collapse, but through accumulated constraint, through decisions deferred, through options narrowed. And because the cause feels distant, the response is fragmented. Each household adjusts alone. Each business adapts independently. The pressure spreads quietly, without coordination. The most unsettling part of this story is that there is no obvious breaking point, no single moment when the system fails, no clear signal that forces everyone to stop and reassess. Trade continues, markets function, ships move. From the outside, the world looks busy, even normal. But beneath that motion, something has shifted. Risk is higher. Trust is thinner, and resilience depends more on adaptation than confidence. This is how instability becomes familiar, not because leaders choose it, not because conflict is inevitable, but because uncertainty is often easier to live with than confrontation for a time. The danger is not that everything stops working. It's that everything works a little worse, costs a little more, and offers fewer options when something finally goes wrong. When the impact becomes obvious through prices, jobs, savings, it will feel sudden, but it will not be new. It will be the result of small decisions made quietly, long before the effects were widely felt. This analysis is not a prediction, it is a pattern. And patterns matter because they show where attention should go before outcomes become unavoidable. If you want to understand how global risk reaches everyday life without a war, without a crisis headline, and without a single dramatic moment, this is where to look. Not at the noise, not at the speeches, but at the systems quietly adjusting underneath. Because by the time everyone agrees that the rules have changed, they already have. If you want to keep understanding what's shifting before it becomes obvious, that conversation doesn't end here.